Welcome to our MyWealth webinar. With all that's been going on in the markets and midterm results right around the corner, we have Kevin Headland, Co-Chief Investment Strategist at Canada's largest asset manager, Manulife Investment Management. My name is Jeff Hunter, and I'm a Senior Investment Associate and Associate Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our Senior Investment Advisors, Dave Townshend and Raheem Somani. For more information about our team, our process, and our exclusive MyWealth global portfolios, please check out mywealthmanager.ca. This call is being recorded, so make sure to check your email in the coming days for replay information. Kevin, I really appreciate you joining us today. We always look forward to whether it's reading your monthly results or your monthly feedback, and you on TV often and this sort. But before we get started, there's a few people who may not be as familiar with you. Want to just give us a little bit more about your background, what you specialize in, and what you bring to the table?
Sure, thanks, Jeff, and thanks everyone for joining us today. I try and describe myself to my friends and family who really aren't in the investment business, kind of a meteorologist for the markets. My job, along with my co-chief investment strategist, Nia, we don't manage any money, but it's our job to kind of get the temperature on the markets and the economy and see where things are going. Of course, we can't guarantee anything like meteorologists, but we have probabilities. So we look at a lot of data. We have a lot of research. I've been doing this job for 12 years. I've been in the industry for almost 25 now. So been through a lot of different experiences. This one is almost top of the list. What's going on, especially this year and last year. But that's what we look at. You know, our job is really to provide information to financial advisors and help guide them to deliver information to their clients and help build better portfolios to get their clients to the end goals, whichever they may be.
Perfect. Well, without further ado, let's just get into it. Yeah.
Sounds good, Jeff. I'm going to share my screen here. Let me know when you can see that there. Perfect. So as I said, really we're about looking at the outlook, seeing where things are going. Obviously, trying to figure out the rest of 2022 and where things are going in 2023. One of the things we try and do is definitely always trying to look forward, right? It's important to know where we came from, but definitely important where we're going. And Brad Paisley, famous country music star, has a great quote. He says, "If you make a mistake of looking back too much, you aren't focused on the road in front of you." And I think it's a really great analogy for investments, because it's so easy to focus on what's gone on, focus on our statements, focus on where we've gone, what kind of returns we've had. But again, it's more important to look at where we're going. I have to say there's a reason why the windshield of an automobile is larger than the rearview mirror, because while it's important to know where you've been, it's that much important to know where you're going and make sure that you have a good view of where that is. And make sure we stay on the right track, right? Make sure we're going to stay on the destination. And this is good. The theme of the presentation right now is kind of give information, but again, focus on that destination, focus on the end goal, and make sure we don't make knee-jerk reactions that could sideline us from getting us to that goal. So what we do is we often look at kind of a 30,000 foot view or 50,000 foot view. We start with the economy. What is going on in the world? And we drill down to more local information like North America. One of the things we look at, one of our key charts that we look at is this chart. It's called the heat map, and it's for manufacturer index. So it's purchasing managers indices. It's a monthly survey of manufacturers around the world. You got all the countries on the left-hand side there. And every month, the same questions are asked of the same manufacturers, essentially trying to determine, is the manufacturer in expansion or contraction? If they're in expansion, the number comes above 50, contraction below 50. And while it's important to look at each data point, it's more important to look at the trend. And what we've done here is, rather than just have black and white here, we've color-coded it. So green is good, yellow is neutral, red is bad. And as I said, we want to look at the trend here. So if you went back to 2020, early 2020, you'd see a lot of red on the screen here. A lot of weakness because of the manufacturer closed globally. Then you have the expansion going into, coming out of the COVID shutdown in mid-2020, you had the big reflation trade. Everything was going good, and things really moved strongly. That's why the markets moved higher. Then throughout 2021, again, mostly good news. Things were moving along. COVID restrictions were easing. Then we got towards middle of 2021, late 2021. We kind of started seeing these inflection points, started things rolling over because they were as good as they were going to get. They were naturally going to slow. Now we're seeing towards the end of 2022, a lot more red, a lot more yellow. This is really to not scare people, but really make sure we're going into the environment with our eyes wide open. What we do believe is we are going to get a recession at some point, likely next year. We could be in a recession in Europe already. Of course, we read the headlines. There's a lot of issues in Europe, a looming energy crisis, proximity to invasion in Ukraine, a lot of issues there. Furthermore, further east, we have Asia. Asia, extremely slow. We know what's going on there. Of course, a lot of zero COVID policies there, slowdown manufacture, definitely a slowing economy. That is a bellwether for the global economy. But closer to home, we are seeing a lot of more slowdowns. We are seeing Canada sub 50, so technically contraction. US right around 50 now as of the most recent data. The other thing we look at for recession signals is this table here, which gives us 7 signals of recession, mostly US data. So we kind of look at the US as a bellwether for the health of the global economy, but also more so the health of the Canadian economy because we're so tied to the US. And this table, again, we color coded it. So green is no problem, everything's fine. Yellow, it's slowing down, we should press the brakes. And eventually red, yes, it is risk of recession. So here we see 3 reds, 3 yellows, and 1 green. So again, more indication that things are materially slowing. Now, I had a grade 10 math teacher who once told me, or once told our class, to be forewarned is to be forearmed. Meaning, if I tell you as a teacher, there's a math test in 2 weeks, and you don't study and prepare for it, it's your own fault if you don't do well. This is the same thing we look at. We look at data to tell us where things are going. Are things slowing down? That doesn't mean we sell out the markets and go to cash. It means we look at the environment and say, where's the best opportunities for returns? At the same time, managing, mitigate risk. This is perhaps not the time to be chasing high risk, high return type products, but more so batten down the hatches, looking at our asset allocation, making sure that we're well prepared for the current environment. The key is for us, though, however, even though we see risk of recession the first half of next year, we do expect it to be a mild, shallow recession. Why is that? That 1 green bar, that is employment. And when we look at unemployment, that's that green line there. The blue line is the 3-year moving average. The green line in the US, extremely low, extremely strong employment. We saw it in Canada too. Canada is very strong in unemployment as well. So when these employment markets are so strong, it's unlikely that we see a deep demand-driven recession. What I mean by that is when we have these deep recessions, they're usually caused by people losing their jobs, and essentially you stop spending. And you stop spending not because you lose your job, but perhaps you stop spending because you're fearful about losing your job, right? You hold on to your savings more just in case things go worse. But right now, employment is so strong that what we're seeing right now is people continue to spending money in different areas, but because of inflation and the cost of goods, perhaps we are spending money in other areas. And although we have money coming in, we're not buying as much going out. So our $1 of earnings or revenue or salary buys 80 cents or 90 cents of goods. Whereas if we're actually lose our job, we're now getting no money in the door, we're completely stopping spending. So that tells us that the economy is going to be weaker. Expect that. Expect, of course, the big headlines to start talking about the big R word and recession. But again, we should not fear that. We also think that a lot of the volatility or risk of a recession is priced in already to the equity markets, given how poorly they've done this year. So that is a good news story, where a lot of the downside risk is likely priced in. Now, the other big word that people are fearing is, of course, inflation. Inflation is the most probably searched term right now in investments. A lot of investors are feeling that pain. Inflation hurts in so many different ways, but also it's hurting our pocketbooks, right? When you see gas prices, oil prices much higher, food costs much higher, Now, this green line here is actual CPI in the US inflation data. The blue line here is what we use as a model to try and predict where inflation is going. Now, over time, that blue dotted line and the green line are very close. It's a very good predictive model. There's been a big difference now, or dislocation. That really comes from the fact that we've had these shocks to inflation. The first one, COVID, supply chain disruptions. We all know during COVID, if we try to buy any piece of furniture, a piece of like electronic components, cars, there was just no supply, right? So we had this big imbalance of supply demand. Of course, that causes price to go higher. The second part, which is the most recent part, is what we call conflict inflation. So we went from COVID inflation to conflict inflation. And that conflict inflation really is the shock we saw in energy and food prices as a result of the invasion of Ukraine. If we had not had that, we probably would have seen inflation actually already start to slow materially as some of the base effects roll off. We've seen already material changes in a lot of inflationary pressures. A lot of commodities have come down. A lot of supply chain disruptions are essentially easing materially. So we are seeing some pauses in the inflationary measures, but it's not just yet there yet. We see that green line coming down, and we believe that inflation should slow throughout next year. We might not get down to 2-3% that the central banks are targeting by end of that next year. But like the heat map, which I showed you in the first slide, it's important to see the trend. Notice that inflation is coming down. Not that prices are going down, but the lack of increase is positive. That's what inflation is. Inflation measures the rate of change or the increase year over year. So those increases will become less, and we'll notice them a lot less going forward, which is very positive for our pocketbooks. One of the things that we're really excited right now on the markets is fixed income. Fixed income is very attractive. Again, looking back this year, it has been one of the worst, if not the worst, years in fixed income. Our balance funds that we typically invest in, because when equities go up, when equities go down, fixed income tends to go up. There's an inverse correlation there, and fixed income or bonds are supposed to help manage the volatility. This is an extremely strange year where the Federal Reserve and Bank of Canada, a lot of central banks around the world, changed their tone earlier this year from not raising rates to raising rates extremely quickly. And this caused a lot of pressure in what we call the yield curve. So when yields move up, like they are with central banks and across different bonds, prices tend to fall. And that's why we got negative returns this year. But that's behind us. We believe we are near the end of the central bank tightening. We believe that the majority, if not all, is already priced in, which tells us that the worst is behind us. The headwinds of rising yields creating negative returns is no longer there. It's essentially no headwinds, no tailwinds, no win whatsoever. What does that mean? That means that when we're buying bonds today or investing in bonds today, we get a much better coupon or yield than we did, by late last year, early this year. This is some of the best yields we've actually seen since before the financial crisis. Our fixed income managers are very excited about this opportunity because not too long ago, but I'd say over the last decade or so, for investors, it's all been about the reach for yield or trying to generate some yield in our portfolio, especially for retirees who need income for their investments. The good news is now with yield much higher, as we're investing new money into fixed income, we are getting higher income, higher yields, and this is a good part of the returns. The next part that we actually see is quite positive for fixed income is typically when we get a recession, yields tend to fall. So this US 10-year yield and US 2-year yield here in the gray bars being recession, notice during each part of that gray bar period, those yields fall. Remember what I said earlier? When yields go up, prices of bonds go down. Well, actually what happens also is when yields fall, prices tend to go up. So the headwind we were facing earlier this year actually can become a tailwind if we get some economic weakness. So that's a positive, despite, as I said, the recession earlier, don't have to fear it. is actually can actually help us in certain areas, especially fixed income. And on the equity side, we believe, again, much of the risk is priced in. Therefore, if we can move through some of this near-term volatility, we can actually get some upside return as we come out of the economic weakness throughout 2023. So in all instances, if we believe that the markets play out or the economy plays out the way we think it's going to play out in 2023, we are very optimistic about the opportunities that exist for both equity and fixed income for balance funds, of course, through 2023. Now, of course, that is all well and good, right? But unfortunately, we are humans. And the biggest obstacle to investing is the space between our ears. We make knee-jerk reactions, right? That's the issue we have. Now, earlier I said I've been doing this for a dozen years or so. Prior to COVID, I spent I was on roughly 60 plus planes per year. So I did a lot of traveling across Canada to the US, even sometimes in Europe. For Canada, speaking to financial advisors, again, telling them what we think is going on in the world. However, every time I've taken a plane, there's always some degree of turbulence, some meaningful, some not so meaningful. However, every time I feel turbulence, my initial reaction is kind of spook. What was that? What was that bump? Yet I know what it is. I know it's turbulence, but I'm not used to it. We're flying along and it comes out of nowhere. So it's a shock. But I sit back and realize everything's fine, right? My plane, my pilot is well educated, versed in terms of flying planes. The pilot will manage the altitude, maybe change the flight path slightly to try and manage or mitigate that turbulence, but they can't guarantee no turbulence. And that's like your financial advisor and your portfolio managers that manage the funds. They are the pilot and steering the plane in the right direction to make sure that they are trying to manage volatility, but not, they can't guarantee zero volatility. Imagine I can get on an airline and they guarantee me zero turbulence. That'd be great. I'm going to buy that plane ticket all the time. So I take that flight, I land, the door opens, I walk out. I realize I'm in Alaska, but I'm packed for a Hawaiian vacation. It was the best flight ever, but I didn't get to where I needed or wanted to be. And that's key when it comes to investments. Again, back to that destination, focusing on the end goal. There's going to be volatility along the way. We have to focus on the opportunity ahead of us. Now, here are these blue dots here, the max drawdowns in any given calendar year. There's always turbulence, right? As I said, there's always going to be some degree of turbulence, sometimes meaningful, sometimes less so. And that's what we tend to focus on as investors. We focus on the turbulence. Yet the green bars here are the total returns during those calendar years. For example, focus on 2020. We go back to March 2020, the S&P 500 was down 34%. Yet the year end finished up 16. When we were down 34%, we did not believe that we'd be able to finish positive. So if we had gotten out and sold because we're worried about the markets, we would have missed that actual nice rally and the upside. So it's important not to focus on the blue dots so much, but the green bars. The green bars on average 14% total return in any given calendar year. 14% drawdown in any given calendar year. But 80% green bars, 80% of the time, they're positive. So despite an average drawdown of 14%, 80% of the time, markets end the year positive. Now that's just looking at calendar years, right? Because that's what we tend to be focused on in investments because we have our statements that come out at the end of the year. So we're focused on calendar year returns. What if we widen our scope here? What if we looked at the probabilities of being positive in any different time period, not just calendar years, but any time period? Now, a lot of us have heard over the years, the market's it's a coin flip, whether it be positive or negative. Well, we crunched the numbers going back 50 years. And that's what it turns out to. Actually, every day, it's literally a coin flip whether the markets are positive or negative, 50-50 essentially. But as you have money in the markets longer, right? It's time in the market, not timing the market. The probability of being positive is actually that much greater. Holding your investments over a 3-year period, any 3-year period in the last 50 years. So that is any 3-year period, it doesn't matter what day you start, but 3 years later, the same day, that's the type of return we're looking at. So not calendar years, but any 3-year 36-month period, you have an 85% chance of being positive. If you're able to hold your money for 5 years, 87% chance of being positive, and 10 years, 95% chance of being positive over any 10-year period. Those are really strong probabilities. This is why we need to kind of work our way through this volatility. When we're in it, it's never fun. But we realize that over time, if we step back and look at the bigger picture, that is another blip, another speed bump on our journey to our destination. But we do eventually get to our destination and realize that that was just what it was, a speed bump. Now, what we're seeing right now is every bear market ends in one thing, and that's a bull market. So we go back to 1956. We look at all the bear markets. Here's the 15 bear markets we've had since 1956. The red bars there. And they each follow with a green bar or a next bull market. Now, interesting enough, we'll notice with the green bars is they are larger and longer than any of the preceding red bars. And that's important because we realize that as we finish a bear market, we do get a strong bull market. I'll take you back to March 2020. Again, the market's down 34, 35%. I'm newly working from home. All our offices are shut down, talking to my colleagues, and we don't know what COVID is. We don't know what's going on. The economies around the world are shut down. We've never experienced that in our lifetime. How bad do the equity markets get? Do they go down 50% like they did in the Great Financial Crisis? Do they go down 75% or more like they did during the Great Depression? We weren't sure. But if we had taken that money out, waiting for a better entry point and try and protect that incremental 5 or 10% down from there, we would actually never got back in, because to this date, we still are not back to where we were that day. Even at the worst point of this year, when markets down 25% in the S&P 500, we were still up roughly 50% from that worst period in 2020. So if we'd taken money out and felt we could time the market, waiting for a better entry point, further down and a drop down of 50%, we would still theoretically be waiting to get back in, and we would have missed a great run up despite the volatility we're facing today. So important, try and avoid the noise, try and make sure we stick to our plan, and most importantly, make no knee-jerk reactions along the way when we feel a bit of turbulence, no matter how bad it may seem at the time. Jeff, maybe I'll pass it on to you and see if there's any questions.
Perfect, thanks. And for anyone in the audience, there is a Q&A button in the bottom. If you have any questions for Kevin, just type it in there and I'll ask on your behalf. The first thing that kind of comes to mind is when you get into recession and you talk about opportunities, can you just talk about the opportunities of quality companies and quality investments and through these types of times, as opposed to pushing on the gas and trying to pick the bottom on some of the lower quality options, especially with the spike in higher yields and the sort?
Yeah, it's a great question. And that's really what we want to focus on. Of course, the last 3 years have really been all about momentum, right? We had the big rally of 2019 going into, things were doing pretty well. Then we had COVID, everything fell down together. Then we had the big rally again after that through 2021. And of course, 2022, everything fell down together. Typically what we do is when we see this, latter stage of the economic cycle, it's exactly that. The companies that provide quality earnings, are selling more widgets, bringing more money in, have less debt, tend to be rewarded by the markets. And we're going to expect to see slower earnings growth. You'll probably read about that. That'll be the next discussion point over the next couple of quarters, is this risk of slowing earnings. The companies actually that do better tend to be the ones that have more sustainable earnings. They just have a better business, shall we say, which tend to be the quality, which quality tends to be rewarded by the markets. And I think it's important to also understand this is not the time to chase after returns. These quality businesses are not the exciting ones that we tend to talk with our neighbors and friends at cocktail parties about, and we made X% in this company. It's these companies that over time grow and provide us with the support, again, to hit our destination, whatever it may be. Sorry, Jeff, you're on mute.
Sorry about that. Do you believe that we're still in a downtrend with the global recession coming in 2023?
Yeah, it's a good question. And of course, we have to decide whereabouts we want to invest. And, we can broad brush and say, yes, risk of global recession. We might see more volatility. I believe that we are in this sideways choppy market, especially in Canada and the US, where I would favor those areas of the world right now over, investments outside of North America, just because I think I have more visibility or more understanding of the landscape versus the uncertainty, especially with Europe right now. But even if we are in a risk of global recession, again, if we think it's going to be very mild or shallow, a lot of that price has been, or a lot of that risk has been priced in because we got the big drop in valuation. We're not saying things are necessarily cheap on a broad base, but I think a lot of the downside is probably going to be muted from here. There can always be downside. We can't guarantee no further downside, but we tend to be closer to the end, especially when the markets are down 25%, peak to trough this year in the S&P 500. The average big, bear markets where, the big ones like the financial crisis and whatnot tend to be down 35%. So, I would say we're close to the bottom. Even we got a big, bad recession, bad markets, there's not much downside from here, I would expect.
And then just with energy, I've got a lot of Albertans in here. There's been a lot of supply constraints on there, but there's also been a lot of fears from demand destruction and the recession. Where do you guys see energy going in 2023?
Yeah, I think when we try and determine, especially commodities like price oil, we try and determine where the balance of risk lie, because it's almost impossible to predict the price. People have been trying for many years, but we look at the balance of risk and where we are today. I would say the balance of risk is to the upside, as you mentioned, supply issues, even the demand destruction. We still have too much supply imbalance right now, so I would expect prices to go higher. We know, of course, in terms of energy companies, specifically in Alberta, a lack of reinvestment in the business right now. So production is likely going to slow over the next decade. Uncertainty regarding government regulations. So as we move forward, unless we get a material drawdown in demand, we're still going to be constrained with our supply. So I think it's still a balance of risk at the upside. And I don't think we're going to get enough demand destruction. Even if we get completely rid of combustible engines and go to alternative fuel vehicles, there is still demand for oil in all kinds of other facets of life as well, especially in manufacturing of those electric vehicles. Well, guess what? The majority of electric vehicles are made of plastic, which is made of oil. So I think there's going to be a big demand still for oil. So I don't think demand is going anywhere near enough to drive prices down, given where supply is right now.
Another one here, just more to do with bonds again. They're saying funds on average are down about 20%. When will the funds reflect the improved yields, or do we need to see a yield drop to see value return? And then just to add on that, just a lot to do with, or that had a lot to do with duration. When do you start seeing duration being positive, or sensitivity to interest rates on the longer end being positive for portfolios, and to look into adding more duration?
Great questions. And I think right now, one of the problems is with yield. Even when prices went down this year, investors were still receiving income. Unfortunately, the price drop outweighed the income we were receiving. The key with bonds as well is that unless the company or government we're lending money to by buying their bonds defaults, we are eventually going to get paid back. It's difficult to watch the price volatility, but ultimately everything is fine. Nothing's gone away. Unlike the equity markets, where essentially a stock could go to zero theoretically, or could remain near low levels for a long period of time. We know with the bond, when it matures, we will get paid back, provided this default. And we've done our research to make sure we're investing in companies and governments that aren't going to default, right? So we get the money back. The other thing is right now is income is paid out over time. So it's either quarterly, semi-annually. So the returns that we see on our statements or on our daily mutual funds are not pricing in all the income due to us going forward. So that is a big delay, and it's a price on a daily basis, which is unfortunate. Not really the best way to price bonds for investors, because again, It's not about the risk of the underlying bond. It just happens to be the most recent value that bond is traded at on the markets. Now, duration, another great question. So right now, what we see the sweet spot of bonds, because we can buy so many different types of bonds, is really what we call investment grade corporate bonds, meaning good quality businesses, companies that you're well familiar with, the rails, the big banks, all kinds of good businesses, whether it's in Canada, US, that issue bonds. We're investing in them right now because they have a nice attractive yield, somewhere higher than 5-6%. But also the majority of them we're buying at a discount, meaning less than they will mature at a par. So as we're holding them towards par, those prices slowly move towards par, sometimes faster than others, but eventually they get back to par, which means we get a capital gain over time. That's where the benefit is of the returns. Now, Jeff, as you alluded to in terms of duration, as we get closer to the risk of recession, when bond markets start pricing in the risk of recession and have already priced in peak moves in central banks, the long end yields, like the 10-year treasury yields, the long government bond yields, tend to start falling. That's when you want to add duration. That's when you want to take on the safer, higher quality bonds, longer duration, to get the benefit of that price falling, which again generates the yields falling, generates the price increases, right? So really about it being an active manager approach in fixed income to take advantage of the different environments we're going to go through over the next 6 to 12 months is really a attractive opportunity for us and our fixed income managers that are, as I said, are extremely excited about the environment right now.
Well, just on that and a little bit more on fixed income, just because it is such a unique year. What kind of magnitude in terms of yield increase will we need to match the first half of the year? Like we're even just looking at the overnights from 25 basis points to 375 in Canada. Just to give people a little more peace of mind, the effect of, or how much more would yields have to increase to really mimic what has happened this year? Not to obviously the exact percent, but
it's actually surprising because you would have to see a much bigger move in yields to get anywhere close to what we experienced already this year. Because I don't want to get into the technical aspect, but one of the two components of returns and fixed income is the move in price, which is affected by the yields, but also the income you receive. Go back to earlier this year, the yields were so low, so the income we were receiving on bonds was so low, there was zero cushion for if bonds moved higher, if the yields moved high and the prices fell. Now, because the starting point yields are much higher, we have that cushion. So if, for example, the Bank of Canada were to raise rates another 350 basis points, you would actually not get the same impact you did over the first 350 basis points because we have that cushion built in. So they have to go even harder to get the same downside risk. And again, we know, I think, what the big issue is right now is the sensitivity that Canadians have to higher interest rates because of the mortgages. The Bank of Canada is unlikely to move much higher because they know how indebted the Canadian consumer is and the risk of having that extreme recession, which they don't want. Despite the media saying the central banks want to create a recession or quote unquote crush the economy, they don't want to have a big, deep recession. They just want to get enough economic slowdown to slow that incremental demand down that has caused a bit of the inflation. And that's what we're trying to do now. They don't want to get a deep recession because that's not the central bank's goal. When we get a deep recession, guess what the central banks do? They cut rates. And they don't necessarily want to do that right now because that doesn't help slow inflation.
And just a little bit on the global side, we've had a very US focus driven bull market coming out of 2008. But even within the US, there's a huge division almost of growth company valuations and essentially the rest. What can you kind of see going forward from a valuation standpoint, not only from focusing on the US, but the benefits of having global diversification and not just trying to chase the one hot market?
Yeah, I think it's important to have diversification around the world. As I said, right now we're less positive on international equities and emerging markets because of the uncertainty. But over longer term, these businesses are really strong. There's some really great businesses that are in the UK or in Europe or even in Asia and China that if they were elsewhere in the world right now, they probably would have a much better return. they're just being impacted by some of the geopolitical or other headwinds or dark clouds around them. The US, of course, we know it's mega cap names, called the FANGs, called the tech stocks, whatever you want. Those are broad brushes, but it really is the largest capitalization companies that tend to drive the market. Now, they've been doing really well. And what happens is when they're doing well, the rest of the market does well because they're so big, they pull the overall calculation of the index with it. That doesn't mean other companies are not doing well. You just don't realize how well they're doing because they're not as sensitive to the overall market. So one of the issues right now we're seeing, and I think going forward, is I think a lot of investors, and when I say the market, the general investor, wide investor, will start looking at the quality of the companies, right? What are the real earnings? We call it from the macro to micro, really about the businesses. And that's what happens over time. Sometimes the time is longer, but the market tends to reward those good businesses because, if you're chasing these, high flying companies that maybe aren't really good businesses just yet or having problems, but people don't realize because they just price goes up and we chase it, momentum, right? FOMO, fear of missing out. We better buy this stock now. It keeps going up. Unfortunately, we've seen what happens is eventually they fall, and trying to time that doesn't work. And that's the biggest issue. When you try and time momentum markets on the upside, you often get hurt because eventually the air is let out of that balloon and they fall.
And just given the volatility and just the greater adoption of alternative investments, where are some other areas that you see outside of the traditional equity markets that you guys have some exposure to?
Yeah, I think it's one area which I think we're going to see more and more of over the future is what we call alternative investments, and most of what we call real assets. So investing in farmland and real estate and infrastructure. We have timber, so we have essentially tree farms that we own and we cut down to provide lumber, and then we do reforestation. So we actually plant more trees than we actually cut down to make sure we're planting that. But these are alternative investments that typically for qualified investors, only for certain investors because of the regulation we have in Canada, but they really give a diversification to what we call the public markets, which are priced daily. So it kind of smooths out some of the volatility. Unfortunately, where we are in the public markets, that daily pricing of either bonds or equities really adds more volatility. It doesn't necessarily add more risk, right? If we're investing in the right companies, it adds more volatility, that day-to-day price movement. And unfortunately, some investors rather, even sacrifice some upside return to get better volatility mitigation, which over time, from a risk return perspective, gets them to destination and helps them sleep better at night. So some of these alternative investments that help manage that volatility, mitigate it, can really help those clients who are, again, qualified to invest in those type of products.
Awesome. And then again, if anyone else has any further questions, just in the Q&A in the below. And then one further one, politics. We've got the midterm election. Everyone loves talking about politics, or they do seem to these days anyways. How much impact does that have on the markets, longer term and shorter term as well?
It's a timely question because I'm actually just did research on this. I brought some data that I had from previous presidential elections because that's what we focus on. That tends to be where a lot of the questions come from during presidential elections. But of course, more and more, even midterms in the US are being contentious and very difficult to predict. But ultimately, I went back to 1945 and looked at different combinations of presidency and Congress, whether it's Senate or House of Representatives, to see if there was really any combination that does better than others. And essentially, it doesn't really. Over time, the SP 500 has favored a Democrat president, but that's also because of some of the greatest years happen to be under a Democrat president. Sometimes the worst years happen to be under a Republican president, not necessarily because of their policies or anything, just happen because of what happened in shocks, right? Like the great financial crisis, 2008, the tech wreck, both of those happen to be under Republican presidents. But it wasn't anything they did, just happened to be that way. But over time, politics, the makeup of the governments, Senate, Congress, don't tend to really change anything year to year. Maybe there's some issues. The old adage is that the markets tend to favor what we call lame duck presidents, where presidents are in power, but they're the opposite party controls Congress, which means essentially nothing gets done. And markets tend to like the status quo. They don't like to be surprised. If they know nothing gets done, they can focus on their fundamentals of the companies and not worry about any type of legislation coming out that could hurt them. So that tends to be what markets like. But I said over time, the long-term averages, no real difference whatsoever.
Perfect. Well, hey, I just in the interest of your time, thank you again. Really appreciate your insights. You guys are invaluable to our team just on the overall sites and your monthly commentary. For everyone on the audience, we'll be sending out the replay information. If you have any more questions, feel free to contact Dave, myself, or Raheem. More than happy to get you an answer from one of the team or comment on the specifics yourselves. With that, have a great afternoon. Thanks again, Kevin, Michael.
Thank you.